All right. So with me today is Lillian Ferndriger, Director of Alternative Distribution at BMO Asset Management. Lillian has extensive experience in working in alternative assets and is passionate about bringing alts to retail investors. Thanks for joining me today, Lillian.
Thanks for having me. Excited to be here.
Excellent. Lillian, there is a lot of talk going on in the industry about the democratization of alternative assets, which has many fund managers thinking about whether they can access retail capital in order to grow their assets under management. What is your perspective on this trend? Are you seeing it play out?
I'm actually very excited about this trend because I'm on the other side of that trade. One of the reasons why I joined BMO GAM is for the exact fact that we want to be able to democratize access to alternatives, which generally have been the domain of the institutions. So yes, there is a trend of ultra high net worth and high net worth accredited investors now getting access to what traditionally was only available for institutions. And when we delve a little bit deeper about why that is so exciting for us right now, there are a couple of stats that always shock me whenever I talk about this. If we look to private equity in particular, over 80% of companies in the US of size are private. When we're looking at the top 7 companies in the S&P 500, that makes up 25%, and they're all tech. So when we're looking at the opportunities that we now have for individuals to actually get access to this exciting world, it makes me really excited. So I'm happy with the trend that's happening right now, that we found a way that we can package institutional quality product and be able to bring it to the everyday Canadian.
That's a great segue to my next question. So from an investor interest perspective, are there any particular trends you're seeing with regards to desire for certain strategies, geographies, and so on?
For sure. So alternatives is quite the broad term. It's anything that is not publicly traded or cash. And so when we look to the alternatives market, there are so many opportunities that are there. At BMO, we are actually narrowing that a little bit further to get access into private markets, because we see that that is where the trend is going right now and the ability to get access to that institutional world. But when we're looking at the retail market and what they're looking for, private equity is definitely one that people want to get access to. Anything that has to do with yielding product and steady yields is also very interesting when it comes to private credit or real estate infrastructure where it's contracted cash flows. And so the best, and what I'm excited to say that we will be launching, is having an opportunity to do a one-ticket solution where you can get access to all 4 buckets of the private markets. And we're doing it in a way that's accessible for investors. So you can buy it every month and you can redeem with notice. And that's a little bit different than the traditional private equity closed-end deals that most of the institutions do to get access to that private equity. It makes it a little bit easier for an advisor to put it into their portfolio and into their models. And the way that I like to break down when we're looking at where this fits into a portfolio is there's 3 outcomes that we're looking for from private markets. We're looking either for a return enhancer, an increase in income, or a diversifier away from public markets. And so when you are able to put that all in a one-ticket solution, it is pretty exciting because one of the trends that we're seeing in retail is that many advisors are shying away from private markets. The education is not necessarily there because the access had never really been there before. And it's a heavy lift under client-focused reforms and know your product for advisors to feel really comfortable in how these products are evaluated, how they're traded on FundServe, what the documentation looks like, and most importantly, how do you describe this to your investors? And so the trend that I'm seeing right now is to make sure that it's something that we call evergreen, so you can buy it every month, and it's open-ended, that it's easy to buy, and that you have the support materials needed to be able to explain it to your clients.
Yeah, that's super interesting. And from a geographical perspective, do you tend to find, is it mostly Canadian companies or the US, or what does that look like?
So we are definitely seeing more American companies or global companies coming into Canada right now, because there is that trend of institutional companies coming into the high net worth market in Canada. In Canada, it is still fairly small, but there are opportunities. We ended up doing a private equity traditional closed-end deal with Georgian, which is a Canadian success story in private equity and in tech. So that was a lot of fun. And we had a lot of learnings from that too, in that the market needs a lot of support to be able to bring these products to investors. So there are definitely Canadian success stories out there that need to get that distribution and want to get that distribution, but they're being overshadowed generally by some of these very large institutional managers that are coming into Canada.
Yeah, no, and I've experienced that firsthand when I was in the asset management business too, right? You've got the really big guys who are getting bigger, and then there's sort of everybody else trying to carve out a space for themselves as well. And as it comes to, I suppose, Canadian managers might be wondering if they're interested in getting on your shelf. Do you have any advice to share?
One of the big things that smaller managers have the most difficulty with is their operations. And so when we're looking at doing our operational due diligence on the partners that we're partnering with, that is something that we spend a lot of time on. So you find that a lot of Canadian managers are smaller. They may not have a separate CIO function from their chief compliance officer. They may not have the back office capabilities that are required to get into the retail space because they don't have the support that's required. Being able to be really tight on your operations is number one that's needed to be able to come into the retail market. And we've seen that over time where I'm part of the board at AMA. And one of the things that we really are passionate about is to be able to give voice to some of these smaller Canadian managers to be able to get opportunities for them to be distributed. In Canada, the way that it works is all the dealers have to approve these products. Otherwise, it's unsolicited if you're lucky enough to be able to get a dealer agreement to begin with. And there are criteria that is required by the dealers. So when it comes to AUM size, your operational due diligence, and your audit and all that. So it's a heavy lift because it's expensive to be able to do that. So when we look to smaller managers, and any advice that I could give would be trying to find a partner in two ways. Either if you're able to partner with a larger firm that has the distribution capability to sell your product into the channel, or finding ways to work with mutual fund managers that are willing to put up to their 10% weighting into their funds. Because that's another avenue that you can get your product into the retail channel. And then finally, of course, if your product is available in a liquid alternative, it does make it so much easier when it's a prospectus-based product.
Yeah, and I'm curious on that one. So you already mentioned closed-end funds are a bit of a challenge. So is liquidity something that is a must-have for sort of anybody getting on your platform to realistically get traction?
So it's so interesting. I've been in alts now for almost 10 years. And when I first started, liquidity was king. It did not matter what your underlying product was. If you did not have liquidity, there was no chance of your product getting approved. Even if the underlying are 2-year loans or lockups of 5 years, the market wanted liquidity under the assumption that if you are able to redeem, that must mean that you're safe, that you're protecting the client. Over the past decade, that narrative is now starting to change within the retail space. Institutions have known this since the get-go, which is why they have no problem putting in over 50% at times into private markets, because they understand how there is a liquidity or illiquidity premium that you can earn by staying locked in.
Absolutely.
The retail market right now is still so new, this concept to them, because everyone is terrified that something is going to happen and they can't get access to their money. When you're buying these private market products, this is where it comes in with the education. Understand how it fits into the portfolio and that you do not need to have the liquidity, because it's very unlikely that a client is going to come to you and say that they need to redeem 100% of their portfolio in T+2. And if they are able to say 30% that they are not going to touch, the increase in returns that they can get from being able to sustain that time frame it's astronomical. And that is why the institutions, and especially our Canadian pension plans, have had such good returns over the years, because they're not scared of locking in things. So when we look to closed end versus evergreen, the way that we like to look at it is, let's have a core of an evergreen private markets portfolio for your alts weighting, where you are able to get that access. And yes, you can get out with a notice period. But then when you want to do your return enhancement, let's go into private equity and lock that thing in for 10 years. Because a 10-year lock doesn't mean 10 years. Every time the companies get sold, the portfolio companies get sold, you do get a distribution, but you have to be prepared that you may end up not seeing anything for 10 years, according to the documents. If you end up wanting to get more income or more steady income, let's look to real estate and infrastructure. And that's the other thing I find really funny with the liquidity conversation is Canadians have no problem buying a house and locking in for 30 years. But they don't seem to understand that when you're going into private real estate, it's the same thing. You are buying, fixing, and selling, but at a greater scale. And you can't get access to that money right away because a building is not going to sell within T+2. So overall, I think that the market for the retail market is moving in the right direction, trending in the right direction, and that it's our responsibility to help educate the market and teach them how they can actually put this into a portfolio.
Yeah, that makes a lot of sense. And I'm just curious, do you see BMO potentially having a role to play in, let's say, if one of your investors is invested in a certain private equity fund and for whatever reason now is seeking liquidity, like do you ever see BMO taking a role and saying, hey, perhaps within our, perhaps there's a BMO facility to provide some liquidity, or make a marketplace concept where other clients perhaps want to invest? Do you see anything like that coming down the pike anytime soon, or is that just simply too challenging from an administrative perspective?
It's certainly a challenge, but it's one that, of course, we're all looking at right now to find a way, because that is definitely that secondary market, and trying to provide liquidity to advisors is certainly something that we want to provide for them, but we have to find a way to do it and be able to develop the construct for it. So we're not quite there yet, but stay tuned.
Excellent. Excellent. And just a question on sort of the whole evolution of investments. And there's also been quite a lot of media coverage around, the intergenerational wealth transfer from baby boomers to the next generation. And I'm kind of wondering, like, are you guys seeing that? And is there really are you seeing a shift in like investment preferences, like ESG or impact investing, or is it really more talk than noticeable differences at this stage?
I still think in the retail world, it's a lot of talk.
Yeah.
I think it's coming, and I think it's a very good conversation to have. The intergenerational wealth discussion has been going on for ages. And now adding this added sleeve of private markets with longer time horizon is starting to make a lot of sense. So a lot of advisors do shy away from having their older clients in a longer term product. And I totally understand why. But if it becomes part of the intergenerational wealth plan, there may be a space for it. So there might be opportunities to still get access to these type of products. Because when we look, the sweet spot really is for private equity in particular, are the young entrepreneurs. And for those entrepreneurs that have already sold a business, because they understand what it takes and what support a PE firm could have in their business. And they understand the risks involved, or why they don't view it as risky as perhaps someone that does not own their own business. So we see that that's also a sweet spot when it comes to the type of clients that we speak with, are business owners too. When we look to more trends when it comes to ESG, this is something that is very important in the institutional world. In fact, it's now getting to the point where many pension plans will not invest in a firm that does not have certain requirements in the ESG space. And I even saw that starting to come down the pipe 5 or 6 years ago into the retail world, but I don't think it's proven yet to the retail market. And I don't think it's proven yet that there are outsized returns when it comes to some of the ESG initiatives. But in the end, what we are seeing are the awareness is there and wanting to support companies that are doing something good for society. And I think that all the research has shown that your 20 and 30-year-olds are really starting to get into impact investing and start getting into more of the ESG because they don't want their money supporting something that they don't believe in. And so I think it's going to be that push from this generation on the retail side that is going to make people stand up and notice. So you're going to have the top-down push from the institutions, and then you're going to have the younger generation with the bottom up. And in the end, we're going to try, investing in things that make the world a better place.
Yeah. Yeah, and I think certainly from what I've seen, the trend has been around, or the push has been around in Europe for a bit longer, but it does seem like slowly it is coming to North America as well in a much bigger way.
And then when we look at, there's one product or one portfolio company in the BMO Partners Group fund that's coming out, where it's a European German toy company, and it's Schleich is the name, and it's so interesting because they were able to make money by being more environmentally friendly. In Europe, because they are further ahead than North America, there are surcharges if your packaging is not environmentally friendly. So one of the first changes that Partners Group did when they ended up going into this company was change the packaging. It ended up doing an automatic lift into their end return. They also then started looking at how to make it more recyclable, make it more environmentally friendly by changing the paint that they use for these toys. So again, ends up being more profitable for the company, but better for the environment. And if we can keep having those type of stories out there on how we can influence companies with our investment to make smarter choices, and see the actual return come from that, I think that that's going to end up pushing us in the right direction.
Yeah, no, and that's great to see that play out. And perhaps going back for a moment to from a fund manager perspective. So you've mentioned key challenges. So liquidity, closed-end funds is one aspect. The operational readiness when dealing with a big firm like BMO, but are there any other recurring like challenges or opportunities that you think a fund manager should be aware of? And I'd love it if you could also speak a little bit about even if you do manage to get onto the shelf of a big bank, what should a fund manager be ready for in terms of really working with financial advisors to gain more knowledge about their products and actually get some commitments flowing in?
So when I first started on the alt side, I was in national accounts. And so my entire job was trying to get product approved at all the different dealers for the retail market. The biggest challenge, and we talk about this at AMA all the time, is risk rating for OM products and private market products is by far the largest challenge that we're finding for adoption into the retail market. So almost, not all, but the vast majority of dealers in Canada, if there are more than 40% of the fund is private, it'll be an automatic high risk weighting. And that high risk weighting is detrimental to the conversation that you're having with an advisor. So advisors or manufacturers should be aware that the risk rating is going to be a huge challenge. The second challenge is offering documents and subscription forms and just the process behind getting a trade through. Each manufacturer does it differently. The trade times are different. The notice periods are different per product. different dealers have different requirements on what forms need to be signed, because not only do you have the manufacturer's form, but you're also going to have the dealer's form, and perhaps even needing branch manager sign off before a trade can go through, as well as the accredited investor attestation and making sure that your client is accredited, or if you are a discretionary manager, signing the form on behalf. But these are all things that when you come into the alts world, becomes quite daunting. And so for a manufacturer that wants to distribute, they have to have a good plan on how they're going to handhold the advisor through this.
Yeah, and when it comes to the advisor education piece, I'm curious, would you in your role facilitate that at all, or is that sort of up to each manager to try and, you know, figure out sort of like which advisor they might want to be speaking to about their products?
So that is definitely one of our mandates, is to get more education out there. And there are lots of sources for education too for an advisor that's not just from a manufacturer. I keep talking about AMA, but AMA has a lot of resources for all managers and for advisors to learn about alts. It's a great spot where you can find due diligence questionnaires, where you can find articles on questions to ask your investor when deciding on what type of investment you want to go into. It talks about many of the different challenges that we've discussed already today. There are articles galore and conferences and learning opportunities through AMA. The other one that we use quite often is Preqin, where they amalgamate a whole lot of information on the alts market globally to be able, so you can run simulations and be able to get access also to a lot of education. But at BMO GAM, one of the things that we're really looking towards is to be a leader in education and awareness, to be able to democratize access to the private market. And so I'm part of that group. The entire alts team is part of that group. We have a specialized sales team just dedicated to help with the wholesale team that is going out and speaking with advisors. So it's a whole team supporting advisors out there. And I think that that's something that's going to help us win in the long run.
Yeah, excellent. And maybe for those managers that are lucky enough to get on the shelf, any comments on the whole performance reporting piece? Are you generally happy with the type of reporting you're receiving, or is that also still a work in progress?
The reporting is definitely a work in progress. I do know that many dealers do require Morningstar that your fund is on Morningstar, so that they can process, or they can monitor performance for their funds. Even internally at the dealer, that's always going to be a challenge on knowing who has bought what and where and how much and when. So operationally, it is still a heavy lift in the offering memorandum world for many of the different dealers that are out there. The dealer that can get it right, I think, will have a competitive advantage. And we are starting to see some of the dealers out there that are really starting to embrace technology. And I think that they're the ones that are going to be heads and shoulders above. If they can find a way to make it easy for an advisor to fill out the forms and to be able to get the trade through and to monitor it, those are the dealers that advisors are going to want to deal with.
Well, awesome. That's good news for companies like mine. Well, thank you so much, Lillian, for your time today. We really appreciate it.
Excellent. Thanks for your time, Anne-Marie.
Thanks.